All right, good morning, everyone. We're going to finish with a couple of currency items today, and then I do want to start export benefits, and that'll be our last subject matter for outbounds, and then we'll do the plan chapter after that, which is kind of long. But remember, we started on Wednesday foreign currency translation issues. Translation issues are when I'm doing a business activity in a non-US dollar functional currency. I need to translate that back into US dollars when I include it on a US tax return. So, in addition to translation issues, which is just that conversion of an activity back into US dollars, issues can arise when a US taxpayer directly engages in transactions with customers, suppliers, lenders, borrowers, and financial institutions that are denominated in a foreign currency. Okay, so now we're talking about a U.S. party doing something directly with another business party and denominating that transaction in other than USD. Okay, so now this is a transactional aspect here. Taxation issues surround the timing and character of gains and losses due to fluctuations in exchange rates between the time the transaction is entered into and the time the transaction is settled. So if it's a sale of inventory, I'm selling to a foreign party directly from the United States, the business people may negotiate that transaction to denominate that sale in other than US dollars. So then my receivable that I would record, right, because businesses never sell for cash, right? They sell for receivable. The time I enter into the receivable, by the time I collect the receivable, if that receivable is denominated in other than US dollars, I win or lose based on the exchange rate. Just like the 987 stuff we talked about on branch remittances, which is the difference between when the money is earned in a branch and when remitted, that win or loss economically on the fluctuation in exchange rates, the U.S. tax code tax affects that economic gain or loss due to the exchange rate fluctuation. Okay, so again, I don't give you a lot of code sections. This is a famous one, section 988. You remember back to Monday, the branch remittance gain or loss computation that we were going through in that that formula I had in the yellow filled box. That was 987. So this is sequentially right after that. So all of our currency stuff is pretty well grouped in one spot. It goes from like 985 to 988 for U.S. tax purposes. But that's all the stuff about QBU, all the stuff about functional currency, the stuff about branch remittances, and then the foreign currency transaction stuff we're going to talk about right now. So 988 and the accompanying regulations provide the rules for determining the amount, the timing, the character, and the source of foreign currency gains or loss associated with so-called 988 transactions. So practitioners will always talk about when they confront one of these issues, I got a 988 transaction. That means that the U.S. Taxpayer has entered into a transaction denominated in other than U.S. dollars. And those transactions typically fall into, I can deal in non-functional currency itself, right? So if a U.S. taxpayer owns euros and then disposes of the euros, that is a transaction in property. No different than any other type of property that I have, right? Just because it's a currency, it's not U.S. dollars. So I'm going to have a basis in that non-functional currency, and then I will have a disposition of that non-functional currency, and those amounts will differ because exchange rates jump around all the time, right? That doesn't happen when I deal in U.S. dollars. If I'm a U.S. taxpayer and I have U.S. dollars in my bank account, they're worth something today, they'll be worth something different next week, but I don't have a gain or loss when I dispose of U.S. dollars, because that's my functional currency. Anything else, I have gain or loss that is economically going to be a win or a loss, and the tax code under 90D is going to tax affect that. The second area is you could have debt instruments or receivables or payables where the amount the taxpayer is entitled to receive or required to pay is denominated in a non-functional currency. Not the currency itself, but if I do a sale and I record that in accounts receivable, and the receivable itself, the transaction itself is denominated in non-functional currency, then I can have gain or loss fluctuation between when I book the sale and record the receivable, and when I collect the cash and relieve the receivable. And I will win or lose on that transaction, and I will tax affect it. Financial instruments, such as forwards, futures, and option contracts denominated in non-functional currency. So if I have raw materials and I'm trying to protect myself on the movement of the exchange rates on, or the movement of spot rates on raw materials, I may try to do forward contracts and things like that. If those are denominated in non-functional currency, I have the same issue between when I enter the contract and when I close the contract. One of the things that makes all of these very difficult is not only does there's a tax risk of a gain or loss here that would be tax affected, there's a book financial statement risk of gain or loss. And companies and treasury departments will try to hedge and mitigate risks, right? So if they go out and do an instrument to counteract or hedge against a risk that's latent in a business transaction, and if that's in a non-functional currency, then I have to deal with that. And there's lots of rules on when I can integrate the underlying transaction that gives rise to the risk and the hedging instrument and collapse the two and treat it as a single transaction. We'll go through that in a little bit. But that's always a fun area to be in because there's requirements to do that for financial statement purposes, and there's requirements to do it to integrate the transactions for tax purposes. Some of the requirements are similar, but you got to make sure you cover off each one of those. And the trick is you have to do that the date you enter into the hedging transaction. You can't do it down the road. So processes have to be in place so that companies can deal with this. And it takes close coordination between the business side of the transaction, if that's in the Treasury Department that is handling those contracts, the tax people, and the accounting people to make sure everything's working the way they want. So we're going to go through all three of these types of transactions, and there's examples on each one. Okay, so if I'm disposing of non-functional currency itself, so I'm a U.S. taxpayer, and I have on my balance sheet cash that is other than U.S. dollars, and that's what we're talking about here. So the taxation of gains or loss incurred upon the disposition of non-functional currency itself is premised on the treatment of that currency as property. So don't think of it as anything else. Yes, it is cash, it is very liquid, but it is property in the eyes of the tax code. Okay? So as with other types of property, any other property that you have, a taxpayer takes a tax basis in the non-functional currency the day they acquire it. That will differ from its fair market value upon disposition due to exchange rate fluctuation, resulting in gains or losses. This is our earlier tax classes when we dealt with property distributions. This is that same formula. What is my amount realized, i.e. what is the value of the non-functional currency when I dispose of it? What do I get in exchange, fair market value? What was my basis in that non-functional currency that I disposed of? I adjust the tax basis. That's going to be my recognized gain or loss. No different than if I sold a 1231 asset, sold a piece of land, sold anything else, right? I got an amount realized, adjusted basis, gain or loss. Okay, so don't get distracted because it's currency, it's not U.S. dollars. So it constitutes property in the tax code. Okay, so debt instruments are receivables or payables where the amount the taxpayer is entitled to receive or pay is denominated in non-functional currency. So gain or loss is recognized to the extent attributable to a change in exchange rates occurring between two dates. Okay? The first date is the booking date, and that's defined in the tax code as the date you enter into the receivable, payable, or debt instrument. Okay? And then the date you're measuring that against is the payment date. That's the date when that instrument is settled. Okay, might be called the settlement date, but technically in the tax code it's called the payment date. So I'm looking for the booking date and the payment date. And then I'm going to measure the exchange rates between those two dates. Be careful always when you're dealing with exchange rates, and you'll see this as we go through the examples. Make sure you're getting your pluses and minuses right. You don't want to say, oh, it's a gain, it's a loss. I like to think, am I, the U.S. taxpayer, better off or worse off? That's my gain or loss, right? Economic. But it's easy to switch your calculation and get offside on that. So, to the extent the amount I receive or the amount I'm required to pay differs between when I book the transaction and when I settle the transaction or pay the transaction, then I have economically gain or loss. That's going to be my 988 gain or loss. So, foreign currency gains and losses on debt instruments, this is important, are accounted for separately from any gain or loss or income or expense under the underlying business transaction that initially gives rise to the receivable or gift. Right? If I sell inventory and I get and I record a receivable from the customer, that's a taxable transaction, right? So that happens if I'm doing purely domestic transaction U.S. dollars, or if I'm doing a sale to a foreign party and it's denominated in non-U.S. dollars. I still have to record the sale, right? Then separately, we're measuring, okay, now I have an asset on my balance sheet, say a receivable, denominated other than U.S. dollars. That's where I'm looking for exchange rate fluctuation between booking and payment. Okay, so I got two steps to that transaction. I just don't have that if I'm doing a domestic sale in U.S. dollars, right? Because then when I collect the U.S. dollars, I don't have gain or loss in U.S. dollars. Okay, so just keep that in mind. Okay, did anybody want to do example 6, 7? I don't think anybody signed up. Got a lot of words, but it's not as bad as
USACO is an accrual basis domestic corporation with the U.S. dollars as functional currency. On January 1st, USACO makes an export sale denominated in Norwegian krone. The sales price is 2,000 krone. The foreign customer remits the 2,000 krone on April 1st, and USACO converts the 2,000 krone into U.S. dollars on April 10th.
So I put boxes around. You gotta just be methodical here. Like if you got this question in real life or question on an exam, it's easy to get lost in all the things. But hone in on the dates and what were the exchange rates on the dates and what happened on those dates, and then you can work your way through it. But just don't get lost in the forest. Just drill down into what are the dates and the exchange rates. Okay.
Spot rates for converting kroner to U.S. dollars is $1.50 on January 1st. $1.45 on April 1st, and $1.43 on April 10th.
So that tells me, right, 1 krone buys $1.50 going down to $1.43. So the dollar is gaining against the krone, right, in the currency markets, because the krone is buying less and less dollars as it's going on. And so since I'm doing transactions in U.S. dollars, my future results of some of these transactions are based in the krone, then I'm gonna lose on that because it's getting less U.S. dollars as I keep waiting because it's going down. Okay, go ahead.
Therefore, on January 1st, USACO recognizes sales revenues of $3,000. In addition, because
so let me pause you there. So that's our translation issue, right? I did a sale. I have to record the sale. It's denominated in krone, but I report my sales in U.S. dollars. Right? So that's just saying on that date of the sale, the foreign currency is worth $1.50. So I have to convert the foreign currency of the sale to dollars, and that's going to be that exchange rate. And that's accomplishing my transactional goal on the sale. Right? I'm getting it in U.S. dollars. Okay?
in addition, because the krone weakened against the dollar between the booking date of January 1st and the payment date of April 1st, USACO recognizes a foreign currency loss on the collection of the revenue. A receivable, I'm sorry. The loss is $100, which represents the difference between the value of the kroner received with payment of $2,900 and USACO's basis in the related account receivable of $3,000.
So I recorded my receivable when it was $1.50. When the Norwegian krone, was worth $1.50, and it went down to 1 versus equals $1.45. So I lost economically. I'm going to get less dollars. So if I do that math, that ends up to being $100, and that's my $988 loss on the receivable denominated in non-US dollars. Okay.
USACO must recognize a foreign currency loss upon converting the kroner into dollars. The loss is $40, which represents the difference between the amount realized from the sale of the kroner of $2,860 and USACO's basis in the kroner of $2,900.
So not only did I collect Norwegian krone upon the payment date, but then I sat on them for 9 or 10 days, and then converted that to US dollars. That's my transaction in the first category, where I was transacting directly in non-functional currencies. So I think that last part is a little bit of a misnomer. Most US taxpayers would have immediately converted the Norwegian krone to US dollars to take off that last exposure, but it's not unreasonable here. What if they had a payment coming up in the last couple days? Maybe they don't want to pay the transaction fee to convert it to dollars, and then go out and have to acquire Norwegian krone in a few days to then pay off a vendor. So there's possibilities that you might not have made that final exchange on the day of collection, but in this one they did. So it just gives you, it takes you through, I put in the bubble here, this takes you through, I think, everything you need to know about when I translate upon the sale. I got the difference between, because I'm not going to do it for cash, I'm going to do it for receivable. And then I got a difference between my booking date and my payment date, because that's always going to happen. Somebody's always going to have a receivable that they can pay, over time. And then if I choose to sit on the non-functional currencies, then I'm in that first category, and I have a gain or loss when I dispose of that. That's the property transaction. And that's where it's okay to pause. I always do, thinking about what does this mean. If I count the first and second transaction, the second and third transactions, I had losses, right? Because the dollar kept gaining against the Norwegian krone. But I think it's always good to just pause for a moment and make sure you've got that right, and it's not the opposite. The fact that I said there was a loss here, does that make sense? And the answer is yes, because I got less US dollars over time. Okay. The character and the source of this gain or loss. The character is ordinary. Why is that important? Because in my taxation of business entities course, if it's a loss, we want it to be ordinary because that can offset ordinary income. If it's capital, if it were to be capital, then I can only use capital losses for corporate purposes against capital gains. So this is good here because the character is always ordinary. So, and we don't give, and you also know this from business entities, we don't tax capital gains preferentially at the corporate level. Everything's 21%. So ordinary is good here because I don't have any upside if it were capital. I have potential downside if the loss is capital. So everything's ordinary here, and it's sourced by reference to the residence of the taxpayer or QBU of the taxpayer on whose books the underlying asset, liability, or item of income or expense giving rise to the foreign currency gain or loss is properly reflected. So why is sourcing important? Think back to our international taxation when we did foreign tax credit. Foreign source versus U.S. source is important. So depending on where is the asset or the liability that's giving rise to the foreign currency gain or loss, whoever's financial statements that sits on, that's going to be driven by whether it's U.S. source or foreign source. So it's a U.S. taxpayer doing it directly, clearly U.S. source. What if it's my French branch doing the transaction? And if it's on the books and records of the French branch, that would make it foreign source. That's important for FTC purposes. For purposes of the FTC limitation, net gains from foreign currency transactions. Remember we had different baskets when we did foreign tax rate calculations, there's 4 baskets, one of which is the passive basket. Net gains from foreign currency transactions constitutes passive basket. So I place it in that basket, do my FTC limitation in that basket to see if it helps me claim any credits in that basket. Okay. Is that clear on what kind of transactions give rise to this exposure? Now you can imagine these exposures exist economically, right? So companies identify that and then try to mitigate that risk, right? Sometimes these transactions have lots of zeros on them, especially if it's a loan, something like that with a big principal amount on it, and you start tweaking exchange rates even by a few pennies times a big principal amount, that can be a big number. So companies will identify these risks and try to mitigate these risks for financial statement purposes. You need to know about that because that contract, whatever that is, a forward, a future contract, whatever creative contract or agreement that is created by the financial people, that has tax effect as well. Okay? So they have a variety of financial instruments. You need to understand those, make sure you get a copy of them and try to read them and see what they're doing for accounting purposes and then see if that's sufficient tax purposes to see if it can mitigate the currency risk associated with cross-border transaction. Where you can get tripped up here is if you do a transaction that gives rise to a currency risk, and then you do a separate transaction to try to mitigate that risk, if they are not integrated in the eyes of the financial statements or in the accounting literature, or in the eyes of the tax code and the regulations, then you have 2 separate transactions. What can happen is you can have different timing and different character treatment on those 2 transactions if the guidance does not allow you to integrate those transactions. What integration does is allows you to treat it, people call it synthetically, as if it were in US dollars. I could do that transaction we just talked about. And I could take those Norwegian krone and I could do that properly to where I convert all of that exposure back to US dollars. I integrate it, then I don't have anything that we just talked about. But I gotta make sure I integrate them for accounting and tax purposes. Okay, so let's do 6-8 Esmeralda. Okay. Anybody want 6-8? Right.
Example 6-8 states that USA code an accrual basis calendar year domestic corporation with the dollar as its functional currency. On February 1st, USA code enters into a contract with a Mexican supplier to purchase raw materials for 600,000 pesos for delivery and payment on July 1.
So now we got a foreign currency transaction, right? I enter into a contract that's denominated in other than US dollars. And that can happen to you. The business people are going to handle that, right? That's like who's got the power in the transaction, right? If you're the customer, you got all the power. You may say, "Yeah, I'm only going to do this in US dollars." Here, the Mexican suppliers say, "I only do this transaction in pesos." Right? It's just which side of the party to the transaction gets the risk on this, but that's a business decision. You're going to have to deal with it as a tax advisor. Okay.
Also on February 1st, USA code hedges against the currency exchange risk associated with this purchase agreement by entering into a currency forward agreement, just an option, with the bank to buy 600,000 pesos for 100,000 USD on July 1st.
So there's important dates here. So this February 1 is when I enter into the transaction in pesos. February 1, good fact. I also enter into the forward contract, currency forward contract, and both of them settle on July 1. Obviously, what I'm trying to do is exactly mirror that risk on the other side of that. That's why I entered into the transaction. But if I don't have those dates matched up, then I'm going to have trouble integrating the transaction. Okay.
The forward contract effectively eliminates the currency exchange risk component of the purchase agreement by fixing the purchase price of raw materials in US dollars at 100,000 USD.
Yeah, so the way I like to think about this, and you guys financial people, you might have a different view of this, but I need to come up with 600,000 pesos on July 1, right? I don't have them today, right? I'm a US dollar taxpayer. So either I can decide I don't care and I'll just deal with it, and if something geopolitically happens and the exchange rates go, I either win or lose, right? That happens. People deal with that depending on the magnitude of this. But assuming this is material and I want to mitigate that risk, one way to do that is I go out to a third party and say, hey, make sure you give me 600,000 pesos on July 1. How much do I have to pay you now to do that? You can negotiate that, and that's 100,000. So now I've locked in, this costs me 100,000. Because when I get to July 1, bank is going to give me 600,000 pesos, and I'm going to pay 600,000 pesos to Mexican supplier for my product, whatever that is. Right? Okay? So that's a perfect hedge. You got the timing is right. And then what you have to do, I haven't looked at the accounting literature in this a long time, but it's all about identification. You have to say, okay, I have this business transaction, I have this forward contract, I want to integrate these two, so I match them together in my financial records. And I designate it, sometimes there's a notation you have to make on it to designate it as a hedge of the transaction, but the government wants to make sure that they are sufficiently related. That's the whole identification and documentation requirement around this. Tax has similar types of rules. You just got to make sure that this gets done. Most accounting and departments are doing this and know these rules. You got systems in place to help you do this. Okay. So in that example, because there is no foreign currency risk associated with a fully hedged transaction, so I matched the amounts, I matched the dates, a taxpayer is allowed to integrate the hedge with the underlying transaction that is being hedged. This reflects that the reality of a fully hedged transaction is in substance a transaction denominated in the hedged currency. So I get this $100,000 is my purchase price in example 6. I am not exposed to this. Okay? Integration treatment requires adherence to certain documentation requirements I mentioned, which may or may not exactly align between the tax and the financial accounting. So you just want to make sure you're getting into those details and understand how you do that. Adopting and following policies around documentation of hedges and their underlying transactions and for financial accounting and tax purposes is what's key. So make sure you do that. So you get you might get the economic result you want, but you want the financial statement result and the tax result. Okay. I threw in, okay, so that's transactional stuff, right? So just booking and payment date, make sure you get your exchange rates right. And if you're doing something in currency itself, you're holding currency itself, that is property. Which is why I put this section, I tacked this on at the end here. We talked about this in individuals. But I just wanted to put it in here since we're talking about currency things in general. The receipt of cryptocurrency, right? In exchange for goods and services, that's no different than non-US dollar currency. Okay? Just because it's not a currency from a country, it is still property in the eyes of the tax code. Okay? If you receive cryptocurrency as payment in exchange for goods or services, you must include the fair market value of the cryptocurrency in gross income, right? The same as it would be if you received US dollars or any other currency in that transaction. That is payment. The taxpayer takes a basis in that cryptocurrency equal to its fair market value on the date of the transaction. So if I'm selling something and I agree to take crypto in exchange for that, that is a sale, right? I have to record that as gross income. But now I didn't get US dollars. Just like if I got euros or Norwegian krone, I got Bitcoin, Ethereum, whatever, I have a basis in that cryptocurrency at that point in time. That will differ from the date I dispose of that cryptocurrency. And what is that? That is a property disposition. No different than if I am transacting in non-functional traditional currencies. And I put up here, just as a reminder, the government is constantly working on ways to try to track crypto transactions. So they're putting a lot of onus on the exchanges that do this and the financial institutions that are involved in this, so that there's reporting involved in this. So, like foreign currency, cryptocurrency is treated as property. The acquisition results in taking a basis in the crypto, and disposition results in taxable gain or loss for the difference between the amount realized and the tax basis. This is the same calculation we just talked about before. Keep in mind here, if I exchange different types of crypto for different types of crypto, those are exchanges, right? No deferral, no nothing on that. I've taken one piece of equipment, one piece of property, and exchanged it for another piece of equipment or property. If there's not a deferral rule in place, that's a taxable transaction every time I do that. So, may sound like fun to sit around and trade in crypto and do stuff on your phone, but every time you're doing that, it's a transaction. Have fun doing your tax return. Okay, so we talked about translation issues. The biggest one there is 987. So make sure you understand the 987 concept. That's in a branch form. The difference between when I make the money, take a basis in that because there's a flow-through feature to a branch, when the branch makes a remittance to the U.S. I can win or lose on the exchange rates, right? And that calculation that we went through on Monday is the key there. The foreign currency transactions, it's the difference between the booking date and the payment date. Understand there might be an overlay of a hedge in place for the company to protect themselves. You likely want to try to integrate the two. Okay? And the one thing I would just pass along is on the, as I mentioned on Monday, that currency transactions can be extremely complicated, sometimes big numbers. There's usually subject matter experts and firms that can help you validate these things. So I always found it comforting. I like to learn myself, so I would do the work, but I would want it validated by somebody who's a subject matter expert. Am I missing anything here? Because when you get into these regulations, they can be daunting. Pretty thick stuff.
You mentioned the cryptocurrency stuff. How does it work from more of a tax perspective for some of, like I've been reading about some of the prediction markets, like I think Kalshi and I can't remember the other one, Polymarket. Yeah, like how does that work if they're technically, what I've read is they're not technically gambling, but what I've read is that since now they're banning that in certain states for sports gambling, but now they have it where you can predict, I don't know what you can predict, I think like elections, stuff like that.
Yeah, I think that's an interesting question and topic because I've heard the argument that it's not gambling. I don't understand how it's not gambling, right? You're rolling the dice, if you will. It's something you're going to win or lose, right? And you don't know, you don't have control over that result. So that's another question is whether it's gambling or not.
Right.
But that would be important in how you tax affect these transactions, right? You read those. There was a headline on CNN. Somebody made a big win on the Iran events, and made like $1 million or something in one of the poly markets. And so I personally I would think that that's gambling, right? You bet a certain amount, and then you got a big reward on that. And you guys know from taxation of individuals how you got to report gambling income. It is income. It's just reporting it. Are you a professional gambler or is you an amateur gambler? And so the argument for whether it's because this is gain or loss stuff, right? Because I take a basis and then I have an amount realized when I dispose of it. I guess the argument would be for the poly market and Kalshi is that I've heard it's a contract. Like I've never done one of the transactions, but I think the distinction the companies are trying to make why they're outside of the gambling regulations is because it's a contractual endeavor, which I'm not sure how that's different than using DraftKings on your phone. Is not a contractual matter, but it's a contract that then gets settled, and so it's not technically gambling. And so I'm probably missing all the nuances here, but that's where I think somebody might be saying, well, there's a basis and then there's an amount realized, so it's a gain or loss transaction. But there's no doubt that IRS will come out. This is the perfect example. Perfect example of it takes the tax rules a little while to get caught up with what's going on,
right? Crypto was happening before the tax rules got caught up. This whole contract stuff that's betting on elections and geopolitical events, the tax code hasn't contemplated that yet. So they have rules in place, but they gotta classify it. Like, what are we gonna call this? We call this gambling. And you have the other fascinating thing as an aside, you have the entire gambling industry that's lobbying to make them be gambling because then they got regulation on top of it and that costs money. Good question. Okay, so I want to jump to chapter 7. So chapter 7 is export benefits. This has had a long history, but it really took off as part of Trump 1.0. Remember the Tax Cuts and Jobs Act that we've talked numerous times in all my tax courses? This came, the regimes we're going to talk about here came online in the Tax Cuts and Jobs Act. But it was all part of an overall package that the Republicans crafted about how we tax international transactions of U.S. taxpayers. So this is an outbound topic. Okay? And you can imagine where we're headed, right? If you know the mindset of our president, he wants to encourage U.S. investment, U.S. activity, U.S. manufacturing, U.S. jobs over anything outside the United States. What are they doing? They're saying export benefits. We're trying to incentivize you to do stuff in the United States and access your foreign markets via exporting. How do we incentivize that? We tax you less heavily on that activity. Try to incentivize you to do that. So we are going to do the same thing that we did, unfortunately, in the GILTI world. Trump 2.0 made changes in the One Big Beautiful Bill Act. So we have a 2018 to 2025 regime called FDII. Some people call it FDII. It never really took hold as FDII, but FDII. And then we made changes in the One Big Beautiful Bill Act, which is FDDEI. This is alphabet soup. I think this is more straightforward than GILTI because what they did in FDDEI, that was one of the components in arriving at FDII. So we just kind of like really tweaked the prior regime as part of doing the stuff that they wanted to do to extend things. But we're going to have to compute lots of different terms and stuff, but I think it is somewhat intuitive as to, if you think about the policy, that'll get you to the right result. What is the Republican, I'm going to say Republican, because they're the ones who voted for this, both the original FDII regime and the FDDEI regime. They were the drivers behind that legislation. So, this is not new, even though it started in those regimes started in 2017. We've been trying to do this for over 50 years. This idea of taxing our export activities of our U.S. corporations less heavily than if they did domestic transactions. And that is a desire to support that activity and create U.S. manufacturing jobs, all with the idea of developing intellectual property in the United States and exploiting it globally. You can exploit it globally through export sales. You can exploit it globally through licensing arrangements where you give access to your US-based intellectual property in exchange for royalties. And both of those things are what we're going to talk about here. So we have had various regimes in place to provide tax advantages to incentivize US-based export activity. This is a complete tortured history because there are court cases that go on for decades about these regimes that the U.S. put in place because our other trading partners think they are what is called illegal export subsidies. And world trade organizations and agreements, there are perceived rules that you cannot have illegal export subsidies. Okay? The reason I say it's perceived is because there's a difference in opinion. That's why you go to court, right? But any of you that are from VAT jurisdictions, you know that export sales, you may know, export sales are 0 rated for VAT purposes. Okay? So many in the United States government think that's an illegal export subsidy. You charge VAT for transactions in your country, but when you sell something outside your country, it's 0 rated, meaning that they're going to collect all of their input VAT because they didn't have any, their output, not a VAT person, they would collect all of their output VAT instead of, they didn't collect any, so they collect the difference. And they would, the US many would argue that's an illegal subsidy. Okay? The VAT regimes obviously say that is not. That is just the VAT regime. That's not what we're talking about here. But, so the US has had different rules where they try to tax less heavily our exports. And we argue that it's because your VAT regime, because many other countries, as you know, VAT provides a lion's share of the tax revenue. They don't rely on income tax like the United States does. We do not have a VAT. We're very rare in the world that doesn't have a value-added tax. Value-added tax is a way to really increase a lot of revenue, and so the countries that have that are allowed to lower their income tax rates. We choose to have higher income tax rates in VAT. My editorial as to why is try to run for public office and explain VAT in a 30-second commercial. When you have your opponent lobbing bombs at you saying, oh my gosh, your price of milk and eggs are going to go up and the world's going to end. Very difficult to have an educated discussion as that, even though I see a lot of the merits of a VAT regime, how it raises revenue, how it's efficient, easy to administer. It's just, I don't think it'll happen in my lifetime. Okay, so long tortured history for that. That did not dissuade President Trump, as you can imagine. He weighed in with his view, and he went forth with, I still want to subsidize this type of activity. So we have export benefits, and they are available and very important to U.S. manufacturers. Very important, because they're going to tax this less heavily than 21%. Okay, so Tax Cuts and Jobs Act of 2017 introduced the FDII regime. The reason we're talking about that, because if you go to work for a company now, they're going to be doing their 25 tax return in the summer and fall. They're going to be doing that for 25. And so FDII is going to be extremely important. If you're not graduating until later, or you encounter this, you're going to be dealing with the foreign derived deduction eligible income regime, which is begins in 26 and is intended to be permanent. The FDII regime was not permanent. Remember the whole issue with the budgeting and how the government has a 10-year window, so they play gimmicks, if you will, with the budget, where they have things that are enacted, but they sunset within the original law, so that over a 10-year period, it's budget neutral. So this was one that was going to start to wane away over time. And so that's when they came in the One Big Beautiful Bill Act. Obviously, the companies that were availing of this benefit said, hey, you want to keep this benefit going, right? You want U.S. jobs, you want U.S. manufacturing, right? You extend this, so that's what they did in the One Big Beautiful Bill. So now it's permanent, meaning that it will not go away until we have an affirmative act of Congress to change the law. Okay? So that even makes it more appealing to corporate America. Because you're going to see, when we go through some of the computational aspects here, setting up your transaction flows to avail of this benefit, you might have to change what you've been doing. So if the law is temporary, how much effort do you go through on the change if you don't believe that it's going to be there for enough years? Well, now that it's permanent, those companies that might not have been doing this fully, the idea is now we are. Now we know you can always change the law, but it doesn't change just by the passage of time. You have to get the votes. Okay. So the FDII deduction, so it's a deduction, is intended to incentivize a U.S. corporation to keep its intellectual property in the United States, and when accessing foreign markets, choose to do so by exporting property from the US created by its IP, or licensing its US IP to foreign parties in exchange for royalties. Remember, this came in Trump 1.0, same time as guilty. The designers of these regimes felt that the tax code incentivized taxpayers to hold their IP offshore. Okay? You can find popular press articles about Apple and how much of their intellectual property is owned in Ireland. Okay? So the government established a two-part attack on such activities. They did a stick approach, so we're going to hit you with it. Remember guilty when I said they chose the words to have an acronym that said guilty even though it's misspelled? So what that was, remember, that hones in on global intangible low taxed income. So we're going to manufacture what we think is your low taxed income and then immediately tax that in the United States. Okay? That's the stick. You did something in the prior years and you got an outsized return, i.e. an intangible return offshore, we are now going to tax that starting in 2008. That's guilty. This is thought of when the designers of the regime said, we'll make it a carrot now and dangle a carrot in front of you. Don't even do that. Keep your intellectual property in the United States or bring it back from abroad and put it in the United States and we'll tax it less heavily. Okay? So I think you'll talk to most leaders of organizations and most lawyers that are advising them. U.S. parented companies would prefer to have their intellectual property in the United States. It's closer to the headquarters. They know the legal system. We have rules and responsibilities and legal recourse if there's a violation of your intellectual property in the United States. Right? Companies suing companies all the time about infringement on that intellectual property. If you hold intellectual property offshore, you're not in the U.S. judicial system. There may be less protections. It may be more difficult to enforce your protections. And so all things being equal, they might want to have it in the United States. This is just trying to say one more thing. We'll dangle a carrot in front of you by taxing it less heavily. And there are companies out there who have considered and have moved intellectual property back to the United States by virtue of this regime. But I like to think of it as a package, right? Carrot, FDII, stick, guilty. If you already did it and you're not bringing it back, we're going to tax it. If you bring it back and you don't even start to move it out, we're going to tax it less heavily. And that's the framework of what we were talking about. Okay, so start getting into the details, and we're going to be talking about FDII for 18 to 25. And this is good for when we get to the 26 and forward, FDDEI, because it goes all the way up and then makes little changes to it. But you'll understand where it's going after we go through this. So, a U.S. corporation is allowed a deduction equal to 37.5% of their foreign-derived intangible income, FDII. So we got to determine how much is the FDII, and then of that amount, we get a deduction of 37.5% of that amount on our tax return. What does that do? The FDII deduction decreases the effective tax rate on that stream of income from 21 to 13.125. That math is because only 62%, 62.5% of the FDII income stream is taxed at 21. That is the 13.125. So the carrot they're dangling at you is, I could have taxed your income at 21, but I'm only going to tax it at 13.125 if you do that in the United States and it qualifies as FDII. That's a pretty significant reduction, right? Almost 7% reduction in percentage. Like the guilty regime, the FDII, so we're talking about intangible income, right? Defines the return on intangible assets, just like the guilty, objectively by defining such return as any net income in excess of 10% of tangible assets. Remember when we talked about GILTI? I said the government did not want to get into a debate with every taxpayer about what is intangible and what is not. So all they do is they say, I'll take all of your income, I'll look at your assets, and I'll deem 10% of that on your tangible assets as a return on the tangible assets. Everything else must be intangible. And I do that same rule for every taxpayer. Right? Just quit fighting about the definition of it. It's an objective determination. They do the same thing here because we have that word intangible income in FDII. We're going to do a tangible asset return, and then the rest is going to be intangible. That's what they changed in the one big beautiful bill. Okay, so here's our alphabet soup that we're going to have to go through. So certain defined terms must be computed in order to get the FDII. So first we got to do deduction eligible income. We got to do deemed intangible income. Then we do QBI. If you remember that QBI number, our definition is the same as GILTI. That's our tangible assets. And that's going to get my FDDEI. An FDDEI, that is what our new regime is called. So they kind of pick one of those definitions and keep it. And we'll talk about why that is. So here's your formula. It's not as complicated as what you might think. So once all of these definitions start building on each other. So if you go DEI, then that's this number as well, less 10% of my QBI, and then I got to determine my foreign DDEI, foreign derived, and then that's going to get my FDII. So it'll make sense to you as we build them up, and I like to think of them as building blocks as to what you're going to do. Okay? So we're going to start off with the first one, DEI. So deduction eligible income. So the way this is phrased is it's all income, but certain items are specifically excluded, and I allocate expenses against that income. Okay? So my specific exclusions are income included under the anti-deferral regimes we covered in international taxation. Remember subpart F? GILTI and foreign branch income do not constitute deduction eligible income. So why? I think it's important to understand why. Don't just try to memorize these rules. Why are those items excluded? Because we're starting off with all of your income. All of that income could include some items that are not U.S. centric. Subpart F is foreign income of a CFC that we currently tax in the United States. So it's in my all income, but I don't want to encourage that. I want to encourage U.S. activity. So that's excluded. My GILTI income, that's my stick. That's the income that you earn in your CSC as well under that regime that is currently taxed in the United States. I don't want to incentivize that either. And foreign branch income that flows through directly to the United States, I don't want to encourage that either. So I start off broad and I start carving off things that are foreign so I get to my deduction eligible income. Okay. I like to think of it as this is my U.S. centric activities. Okay. Now I do have to do expense allocation. So directly allocable expenses, those are the expenses that directly relate to that income. Interest, R&E, stewardship, and support indirect expenses are required to be allocated against the income remaining after the above exclusions to arrive at DEI. So the allocation, when I allocate expenses against this number, what is that doing? That lowers the base that I'm starting with and lowers the benefit. Right? If I can stay with a gross number, I have a higher benefit as I go through this calculation. If DEI is lower, then I'm going to have a lower benefit at the end of the day. So one of the major complaints of corporate America was expense allocation is causing this benefit to be less robust than what you think it is. You enacted this in 2007. So you'll see when we get to the One Big Beautiful Bill Act, they took out interest in R&E. You no longer need to apportion or allocate that against DEI.
DEI, meaning DEI is going to be higher. And as you go through the calculation, that's going to keep your benefit higher. And those are two big items for U.S. taxpayers, is two major expenses, interest expense and research and certification. Okay. So DEI, 717. Anybody want to do 717? Okay.
So for this example, USCO owns a CFC that earns $10 million of income from sales to a third country customer for a product that's manufactured in the US. So it's crossing two borders with a related party on one side, which makes it subpart F income. And then because of that like anti-deferral regime exclusion, it won't be included in our DEI.
Yes, so Meta, right? So as Meta was saying, we have a sale of product from the United States to a CFC, and then that CFC on-sells it, right? So remember our shorthand way for foreign-based company sales income was subpart F. Crosses two borders and has a related party on one side. The related party is USCO relative to CFC, and it crosses from the US to country F, and then a sale to third country customers outside of country F. So the income that resides at country or at CFC for this transaction would be foreign-based company sales income, and that's a component of subpart F. That's going to be currently included in this tax return of USCO, right? That is not included in DEI. That's specifically excluded, and I think it makes sense because it's not. The U.S. doesn't want to encourage this, right? I'm not going to give a export benefit for this. That creates activity outside the United States. I want to create activity in the United States. Okay, so that's why that's excluded from DEI. Okay, you might want to do 718. Clyde, let Clyde do this.
USA co-owns the CFC. The CFC earns $10 million of income, all of which the CFC earns by selling products purchased in CFC's country as CFC is a distributor without any depreciable assets. All of the $10 million results in guilty inclusion to USA Co. and does not constitute deduction eligible income.
So keep in mind why is this not in the prior example that was subpart F? Because it did not cross two borders, right? It went from the United States to country F and then was sold to country F. Why? Outside of subpart F, but we had another regime that was layered on top of that, which was our guilty regime, and the facts were important here because it was without any depreciable assets. So remember, guilty was focused on intangible income. If you don't have any tangible assets, all of your income is deemed to be intangible, and so that would be currently included in the United States. It effectively is non-routine earnings because you didn't have any tangible assets in the country. So all of that would be included in the tax return of USCO as guilty, but pull that out of all that income when we do our DEI calculation. Okay. So now I've done my DEI. I know what that is. So that's all income less this stuff that is got a foreign kind of component to it, if you will, a foreign kind of attribute to it. Pull that out. Now I got my DEI. Now I have to compute my DII, my deemed intangible income. And so that's the excess of DEI over my deemed tangible income return. And that is simply 10% of my quarterly average of qualified business asset investment QI. It's the same concept we had in guilty. Right? So now I'm looking at I got all this income from the US. I did my specific exclusion, so now I got my DEI. Now I want to get to how much of that is intangible. I do the same thing as what I was doing for guilty. I look at my tangible assets, I deem a 10% return on that, I pull that out of that, then that means what's left must be my deemed intangible income. Right? Same mindset. Proxy for tangible return, and the residual is my intangible.
And so QBI here is essentially my US-based depreciable property of the US corporation. Okay? It is similar in computation to the guilty inclusion, that artificial objective measure of what is tangible return, leaving the residual as the deemed intangible return. Remember when we were looking at guilty, and I was saying one of the oddities, and remember that Republicans did all of this in 6 weeks, which is a big lift, and they were moving fast because it wasn't already prepared. They were drafting it on the way, drafting it all along during the 6 weeks, and people were lobbying at the time during, oh, you need to do this, you need to do that. So it was frenetic, to say the least. So remember guilty, the amount I'm going to pick up in that prior example, if there were tangible assets in the CFC here, that would reduce my guilty inclusion because I'm only going to get the intangible income is currently included. So remember I said the odd incentive that is that seems like you want me to put my tangible assets offshore because it's going to reduce the amount I include under guilty. Clearly, that's not what you want. You want my tangible assets in Missouri, and Iowa, Illinois, right? That's what you want, but what you enacted didn't do that. Think about what this does. The carrot component of the regime, we're trying to incentivize U.S. activity by giving a lower rate of tax on this type of income stream. Well, I'm reducing the base by your tangible assets, 10% of your tangible assets. What is that oddly incentivizing? Don't put your intangible assets in the United States. So, just like One Big Beautiful Bill changed that oddity in the guilty regime by taking out the 10% tangible asset return, you'll find when we get to the new version of this regime, we pulled out the 10% asset deemed, 10% tangible asset return. Meaning the base is higher. We're going to let all the income. So again, I think it was fixing what they didn't really want to incentivize as part of the location of your tangible assets. But at least for 25 and years prior, we have a reduction in our deemed eligible income to get to deemed intangible income by a 10% return. Okay, 720. 720 is pace.
Okay, example 720. So now US Code has 15 million of depreciable property, and they use this property to produce 10 million of deduction eligible income. So because this is used in the production deduction eligible income, the 15 million worth of depreciable property is specified tangible property, and accordingly it's qualified business asset.
So then I would take times that times 10% and reduce my deduction eligible income for that to get a proxy for what my intangible income is, which is lowering my benefit and oddly incentivizing me to put my next batch of tangible assets outside the United States instead of in the United States. Right? Okay, 721.
So 721 states that US Co. is in the music publishing business and equipment at an adjusted basis of $8 million USD. US Co. purchases the music rights to the latest hot European rocker for $4 million USD. The QI for US Co. is $8 million of equipment and does not include the music rights, which do not constitute QI because they are considered assets.
So this is just saying 10% return, QBI is tangible assets, right? So the printing equipment, yes, tangible, I can go out and touch it. The music rights for this rocker, I can't go out and touch, right? That's a contractual right, not a tangible asset. So when this is just illustrating what I apply the 10% reduction to in writing a DII. Okay, so now I have
deduction eligible, I have my deemed intangible income return. So I'm building up the parts of this calculation, right? I have my DII, we just did, which was my deduction eligible income minus my 10% of my QBI. And now I have my DEI, which was already had before. That's my denominator. That's all my income less my items specifically excluded, less expenses allocated. Now what we're computing is my FDDEI, and that's my final amount to compute this calculation. Okay, so my foreign deduction eligible income FDDEI is, so now I'm trying to look at what I've effectively done is I've gotten to my right income I have in the U.S. How much of that is foreign derived? That's what we want to incentivize, right? What is U.S. derived? I'm taxing that at 21%. Right? I'm not lowering the 21% tax rate. I'm trying to lower the tax rate on the foreign portion of that income. So now I'm honing in on transactionally, what am I looking for that I'm going to assess a lower rate of tax on? Okay.
So it's comprised of income derived from the following transactions conducted by a U.S. company from the U.S. with a foreign partner. I have to be doing this directly from the U.S. So export sales of tangible property. So think of inventory. I make things in the United States and I have a foreign market for it. I need to sell that foreign customer. That is foreign derived. That's clearly in the scope of what this regime is trying to do. Service providers, as they were writing these rules, said, wait, what if I don't do tangible property transactions, but I provide services and I'm global in scope? Don't you want me providing those services from the United States, employing U.S. people, using U.S. intellectual property and availing that to a foreign party by providing that service to them, as opposed to doing this in a foreign subsidiary? Okay, so provision of services, they won that lobbying effort. The government said, yes, I understand, not everybody is selling tangible property, some people are services. We have a large service component in the United States. And then export sales or licensing of intellectual property. So this is saying, if I could sell my intellectual property, which oddly enough, that counted for foreign derived deduction eligible income. I think that got changed. I'll check that before next class on the One Big Beautiful Bill, so that you no longer can sell your intellectual property, but certainly licensing of your intellectual property. So creating it, maintaining it, developing it in the United States, providing access to a foreign party to that in exchange for with the license and getting a royalty in exchange. That royalty income is foreign derived. So I like to think of this as export sales, export services, export licensing, right? And the reason we're doing that is because all that it gives rise to that would be done in the United States, so we're willing to tax that less heavily. So we're going to take each one of these and just explore the details of that. So export sales of tangible property. Sales of tangible property to any foreign person for foreign use results in FDDEI. Okay. A foreign person requirement is presumed satisfied for retail sales if the property is delivered to a foreign address, or in the case of non-retail sales, there is a foreign billing address. The above presumptions do not hold should the U.S. exporter or seller know or have reason to know the purchaser is in fact U.S. based. So, what happens when they adopt these regimes is there's a whole bunch of administration that has to go around this. So they are trying to have a lower rate of tax on foreign transactions from the United States. What happens if somebody gets cute and tries to round trip things? So a piece of tangible property is ultimately going to reside back in the United States. What if I sell that to a, quote, foreign person who then sells it back into the United States? did I inappropriately provide a lower rate of tax, 13.125, than if I'd have done the transaction directly and sold it US to US, which would have been taxed at 20%. That's why you have all these requirements of how do you know that this is a foreign person? How do you know that the use of this is going to be in foreign countries, not the United States? So when they came out with regulations on this, taxpayers are like, oh my gosh, you're giving us this tax reduction by virtue of a deduction to incentivize this activity, but you're putting all this administration on us. You're having to maintain all this information about, is this a foreign person? Is this a foreign use? The government said, yes, understood, but we have to make sure that that is in fact your facts. And they made some simplifying conventions in there so that you can rely on certain safe harbors in doing this. You know, obviously you don't have control over all your customers. You don't know what all your customers are doing. You have to have some conventions in place to do this. You need a foreign person and you need a foreign use for the export of tangible property. So 722. Eugene.
In this example, we see that US Co sells to Megalo, France, a big box retailer in the suburbs of Paris. Because of the widgets of foreign retail sales, the US Co has presumptively satisfied the foreign person.
And so they're presumed to be a foreign person for retail sales if the property is delivered to a foreign address. Okay, so what US Co has as evidence of this being a foreign person and a foreign use is, hey, I'm delivering this to Paris. It's a retail sale. So the presumption is that that is a foreign person and there's foreign use. Now, because it's a presumption, you can't rely on that if you know that that is incorrect. If you know Megalo, France is turning around and reselling that product back into the United States, then you got a problem as the export. But assuming you have no evidence of that, you're allowed to rely on the fact that this is a retail sale to a foreign address, delivery to a foreign address, that it's foreign person, foreign. Okay. If not, it would just be crazy. You'd have to get statements from your customer, what they're doing with it. There's an audit that has to go on. It'd just be crazy mess there. So there had to be some conventions. Okay, the foreign use requirement can be satisfied in several ways. For sales delivered via carrier or a freight forwarder, qualify if the end user receives the property outside the United States unless sold for the principal purpose of resale back in the United States. Again, you're trying to prevent this round tripping and artificial reduction of U.S. taxable income. 723.
So USA Co sells widgets to Megalo, France, a big box retailer in the suburbs of Paris. US Co ships the goods to Megalo, France via Federal Express, and because US Co has sent the goods via a freight carrier, Federal Express, the widgets satisfy the foreign use.
So here, there's the prior example, they were delivering it to the location in Paris. This is now a more likely scenario that you're not actually delivering it, you're giving it to a logistics company that's doing that, but you get to rely on the fact that this is ultimately going to a foreign address, and you get to rely on that because it's retail sales. Okay, thank you. Okay, for sales to a reseller, the property is ultimately resold to a foreign end user. So you can imagine what is happening here. So when taxpayers understand that the purse has been opened, if you will, if you like that analogy, that the government is trying to provide a benefit, everybody starts weighing in and says, well, what about my facts? What about my facts? And so there were taxpayers in this, I'll do this example. Somebody volunteer this. Hey, you got this one. You do this one. So, but this is an example of lobbying when a fact pattern where one taxpayer says, hey, I should get this benefit as well. My facts don't exactly match what you're drafting, but draft this into the law as well.
USCO widget manufacturer with significant Q-buy sells widgets to an unrelated party, US distributor, US disc, which without significant Q-buy sells the widgets to foreign customers. Because a US disc ultimately resells the widgets to foreign end users, the widgets satisfy the foreign use requirement, as long as USCO can substantiate the foreign use.
Yeah, so this is instead of the prior two examples, so this one was a direct delivery to Megalo, France. This one was via FedEx to Megalo, France. What if on the way to Megalo, France, I first sell it to a US distributor? But that US distributor is then collecting products and then delivering them to Megalo, France. So that's where this company was lobbying and saying, hey, that's still export sale. That should still count for this. Even though I'm selling to a domestic company, it's on its way to a foreign export sale. You want me to do that, right? That should count. And they got enough ears to listen to that and got that into the law as well. So if you can support this, that the sale you're making to U.S. distributors ultimately going to a foreign customer, foreign person for foreign use, then that first sale will count for purposes of this. Now, you have to get evidence and stuff, but that's where you can get that information from the U.S. distributor to make sure that you have enough to support your position. So that's just showing you what happens again when the government starts opening this up. It just starts getting bombarded with a bunch of specific fact patterns of people trying to make sure that their facts are covered. Okay, thank you. Okay, last one. For sales of digital content, if the end user downloads, receives, installs, or accesses the content outside the United States, that can be a foreign use. Okay. I'll do this one real quick. So USCO creates patterns for quilting that customers obtain by downloading from USCO's US-based server. Ray Allen, a non-resident alien located in Canada, downloads a pattern from the server. Because she downloads the digital content outside the United States, it satisfies the foreign use content. Again, you can imagine somebody who is providing digital content saying, how do I support that is for a foreign person for foreign use? Well, what if they download that at their location, and that compensation I get for allowing them to do that, that should count for the purpose of this regime as well. Again, everybody trying to get this income bucketed in the FDII regime. Taxed at 13.125% rather than 1. So we'll pick up with this on Monday, and we'll finish our export regimes, and we'll go into the one big beautiful bill action. This one's not nearly as bad as it looks. You just kind of methodically work through the definitions. Okay, I'll send you a note what we're going to do next week. Thank you. Volunteer, make sure you put your name on. That's all. That's partnership. Yeah. So why? So distinction between the 1065. And 1120 is, you need more, so I do think the 1065 is the correct transaction. So you applied for the so now the government's going to look for
Yeah, so they're looking for a partnership tax return. The reason is